This is a comprehensive exploration of the macro theory concerning the transition from a globalized, dollar-based world to a multipolar system, as detailed in the sources provided. The Great Transition, a hinge point in history. We are currently witnessing what many macroeconomists describe as a hinge point in history, a rare moment that occurs only every few generations where the fundamental rules of the global economy are rewritten. The core of this shift is the breaking of the global monetary order, moving away from a world where the US dollar is the undisputed center of gravity to a more regional, multi-power system, where power is distributed more evenly across various nations. To understand why this is happening, we must first look at what the monetary order actually is and how it has evolved. The evolution of the monetary order, from hard money to paper promises. Historically, money was defined by its relationship to physical commodities. In the early 20th century, specifically around 1928, the U.S. operated on a system of hard money. During this era, banks issued gold and silver certificates. These were not merely notes in the modern sense, they were receipts. A citizen could take a gold certificate to a bank and exchange it for physical gold. The bank's primary role was to protect and verify this real money. Everything changed in 1971. Facing the prospect of national bankruptcy, the U.S. officially left the gold standard. This marked the birth of a new monetary order, where the U.S. dollar became the centerpiece of global trade without being backed by any physical asset. The world entered into a unique, unwritten agreement. 1. Global trade in dollars. All countries agreed to sell their goods and energy, specifically oil, in U.S. dollars. 2. Recycling capital. Countries would then recycle those dollars back into the United States by purchasing U.S. assets, such as treasury bonds and stocks. This system created a virtuous cycle for the American economy. Because there was a constant global demand for dollars to buy energy and goods, the dollar stayed strong. This allowed the U.S. to run massive trade deficits, offshore manufacturing jobs, and borrow money at very cheap rates. Essentially, it allowed Americans to consume more than they produced and live beyond their means for decades. The cracks in the foundation. The sources suggest that this decades-old model is now reaching its breaking point for several reasons. Diversification of reserves. For the system to function, the rest of the world must want to hold unlimited U.S. debt, treasuries. However, central banks are now diversifying their portfolios. Notably, gold has overtaken treasuries in central bank foreign exchange reserves as nations look for neutral assets outside the dollar system. The rise of parallel systems. Countries like China have already developed payment systems that do not rely on U.S. banks, reducing the effectiveness of the U.S.-led rules-based order. Domestic decay. The U.S. is struggling with a massive debt problem and a shrinking industrial base. The old model, exporting paper money while importing physical goods and funding global military engagements, is becoming unsustainable. The two Americas, financialized versus productive. One of the most insightful aspects of the current transition is the internal conflict within the U.S. economy. There are essentially two Americas with conflicting interests regarding the strength of the dollar. 1. Financialized America. This is the America we have lived in for the last 40 years. It thrives on a strong dollar. A strong currency leads to cheap imports, which increase the spending power of consumers, higher borrowing capacity, which fuels expanding debt and pushes asset prices, stocks and real estate, higher. Offshore incentivization. Because American labor is expensive, corporations are incentivized to move jobs overseas and use cheap debt to buy back stocks, rather than investing in domestic production. In this version of America, the primary exports are financial assets, like treasury bonds and dollars. 2. Productive America. This is the version of the country that builds things, runs factories, and produces energy. This America actually benefits from a weaker dollar. Competitiveness. A weaker dollar makes American labor and products cheaper relative to the rest of the world, incentivizing companies to build factories at home. Debt relief. A weaker currency lowers the real burden of debt over time. Real assets. It pushes capital toward real output and physical assets rather than purely financial speculation. The current political tension, such as the friction between the presidency and the Federal Reserve, often stems from these conflicting models. While the Fed historically protects the financialized model, political leaders may prefer a weaker dollar to rebuild the industrial base. Measuring the loss of value, the time experiment. To understand the impact of the dollar's weakening on the average person, the sources suggest measuring value in time rather than currency. In the late 1960s, the federal minimum wage was $1.40 an hour. At the time, gold was roughly $35 an ounce. This meant a 40-hour work week, $56, could buy about 1.6 ounces of gold. Today, while the minimum wage has risen to $7.25, the price of gold has exploded. To buy that same 1.6 ounces of gold today, a minimum wage worker would need to work for 22 weeks. This demonstrates that while nominal wages go up, the measuring stick, the dollar, is shrinking, causing people to work significantly longer to acquire the same amount of real value. Why the system requires inflation? Our current system is a debt-based monetary system built on credit. The sources use a simple analogy. If I lend you the only $10 in existence and charge you 1% interest, you can never pay me back because the interest money literally does not exist. To make the system work, the money supply must constantly expand. This constant expansion is why asset prices, stocks and real estate, appear to go up forever. However, when measured in gold rather than dollars, the stock market has actually lost value since the year 2000. The growth we see is often just the reflection of a debased currency. The four major power players. As the monetary order breaks down, four power players are positioning themselves to benefit from the transition. 1. The financial industrial complex, transnational capital. These entities control the financial plumbing, debt, and stock markets. They are comfortable with a weaker dollar because they do not measure their wealth in currency. They measure it in the ownership of real assets, like infrastructure, energy, and real estate, which rise in nominal price as the currency weakens. 2. The sovereigns, national leaders. Leaders of powerful nations want control over their own supply chains and energy. A weaker currency helps them rebalance trade in their favor and reduces their dependency on the global dollar deficit model. 3. The tech industrial complex. As the old order fades, those who control new technologies, AI, digital IDs, financial tracking, gain immense influence. During periods of instability, technology is often sold as a solution for safety and order, leading to more centralized infrastructure. 4. The military industrial complex. This layer enforces changes and manages the instability that arises during power shifts. They benefit from increased investment in defense and strategic resource grabs during times of global insecurity. 2 potential paths forward. The transition could lead down one of two primary paths. The inflation path. If interest rates go down and it becomes easier to borrow, the US can roll its debt over more easily. However, if the world wants fewer treasuries, more dollars stay within the country, potentially weakening the currency and causing inflation. In this scenario, asset prices go to the moon, but the cost of living remains painfully high for those without assets. The deflation or confidence path. If global investors lose confidence in the US entirely, capital could flee the country. To fight the resulting inflation, interest rates might have to stay high, which could cause asset prices to fall. This is considered a much more painful, though perhaps less likely, short-term outcome. Conclusion: preparing for the shift. Ultimately, the sources argue that this transition favors asset owners over those who rely solely on income. Whether we face inflation or deflation, the K-shaped economic divide is likely to grow. While future technologies like AI and robotics might eventually lead to a productivity boom or utopia, the period between now and that future will likely be characterized by significant volatility. What are your thoughts on this transition? Do you believe the US can successfully pivot back to a productive America model, or is the momentum of the financialized America too strong to overcome?